So let's take a look. We mentioned a bit earlier that we would talk about one of the managers in the portfolio. Last time round, it was a different portfolio or different manager that we talked about. But this time round, the manager that we're talking about is a group called Longreach. We've been invested with them for pretty much 6 years now. In fact, just over 6 years since the start of this portfolio. They've actually built an exceptionally strong business, and it's been pretty impressive to watch them grow through the years. They've got a diversified portfolio of private debt. They target returns of approximately 10% per annum, and it's mainly through business cash flow lending. So lending that's secured against the cash flows that come out of contracts that businesses own or operate. It's consistently delivered a strong performance. It's had low volatility. There have been no capital impairments across all the years that we've been invested with them. And the key benefits to our fund have included this level of diversification that has come through a very different style of lending. Their debt strategy invests across a range of sectors. It leverages a deep in-house credit analysis capability. They've got a really strong origination network and team, and this brings them unique credit deals that are not available to the broader market. So I know earlier we talked about battle scars, and this was one of the managers that we came across in the very early days that taught us this lesson. And the guys that operate the portfolio had come out of a significantly bigger lending business in one of the bigger investment banks in Australia. And interestingly, when we sat down with them, you could actually feel the tone in the meeting when they came in just got a whole lot colder. They were just really tough individuals that we felt were able to control and deal with a loan situation. And if something tough happened there, that they would have the ability to go through it. Capital preservation had always been central to their investment philosophy, and the good thing that we've seen there is no capital impairments since inception. They've had one enforcement action, and that seems to have worked really well in the portfolio. As of the last quarterly report, their portfolio has 24 loans, which obviously we're invested into. They've got a weighted average loan life of approximately 15 months. In recent quarters, they've increasingly focused more on the senior secured side. I suppose as the economy has weakened, you've seen them moving into a more secured side of the lending space. In Q3, the fund saw some significant activity, including a whole lot of loan repayments and obviously new commitments in some transactions. And interestingly, what they've also put in place is a new liquidity facility around the portfolio, which helps them reduce cash drag in loans getting repaid and then being redeployed. And one of the tougher things that we'd always found within the lending space was this whole concept of cash drag, especially when interest rates were low. Not so much of an issue today, but going back 4 or 5 years ago when cash rates were low, that cash drag of new money coming in and not being deployed was always a difficult thing. So they've pleasingly found a solution for that in the portfolio.